Hi, welcome back. Today I want to talk a little bit about safe harbors in these turbulent times. Now, nothing's guaranteed and nothing's completely safe. I don't care where you put your money today. But I want to talk a little bit about how successful investors have made money over long periods of time. I particularly want to hone in on one issue, and that is dividends and growing dividends. Growing dividends is simply corporations or companies that over the years have been able to increase their dividends to their shareholders on an annual or a regular basis. So if last year they paid their shareholders $1 worth of dividends, this year they may say, well, we're going to increase our dividends by 10%, which means now they're going to pay $1.10. Well, if you look for companies that have a track record and a history of paying and growing their dividends or increasing the dividends that they pay back to their shareholders, you'll notice that some 70% of the total return of those stocks come from that dividends that's being paid. Dividends represents a show of strength by the management team. The management team knows they can pay all of their bills and their debts and everything else and still have money to pay their shareholders back for their loyalty, if you will. I want to explain why dividends puts a natural floor under a stock, their share price, that may from time to time become volatile for reasons other than fundamental business activity. They may be just as a result of crazy goings on in the equity markets. So I want to talk about how dividends brings people back to those shares, if you will, or puts a floor under the price and can help them to raise it up again more quickly, let's say, than other competing investments. So if you buy a share today in XYZ company that's paying $1 worth of dividends, and you, let's say, have to pay $10 for that stock or share price, the $1 represents a 10% return over the next 12 months on your $10 investment. Right? So, but let's think of it for a minute now. Let's say that for some reason something happened in Europe or something happened in the United States, and all of a sudden the share price drops from $10 to $9. But the company comes out and says, we're going to continue to pay our $1 of dividends. It doesn't matter what's happening in the market, we're still making the profits we're making, etc. So they're saying we're going to pay $1 dividends. Now the new investor who buys that share at $9 is getting an 11% return on their money, or a little better. If the share price then drops further, let's say to $8, and the company's still paying the $1 dividends, now all of a sudden you're getting 13% return on your money or better. So what happens is people say, well, that's very attractive that I can receive that, and this company has a history of paying it, and it actually has a history of making it a little bigger every year. Holy, I can now buy those shares at $8. So that puts the floor. So new money then comes in and buys that stock to get at the dividend. That's very powerful. It puts a natural floor under your value. Now, I'm not saying dividend stocks don't fluctuate. I'm not saying that they can never be problems with them. I'm just saying historically, over long periods of time, they've been a tremendous way to focus your attention in an otherwise very noisy market environment. Give some thought to that when you're structuring your portfolio or talking to someone about it. If you have any questions on this video or any that you've seen previously on this topic, please give me a call or send me an email via the website www.dennisgraves.ca.